I think predictive markets may actually have a real good chance to allow us to get some asymmetric bets in, some asymmetric return. And I just decided to turn on the camera and rant about it for a bit. So we're going to use an example with this Supreme Court ruling that's coming up about tariffs. Again, I know very little about this, but I think this does a good job of showing us what potentially you could use these markets for. So, we know tariffs. We've been talking about tariffs in the market for a year now. And this is interesting because, of course, that's, everything goes to the Supreme Court and they decide yay or nay on tariffs. And again, we're not talking about tariffs and none of that's relevant. But the point is that never before has there been such an easy gauge to see whether or not people are expecting a certain event to occur. So just call this event X, I guess, is one way to look at it. So there's about, it's like, say, 34% chance right now on Polymarket, and then, yeah, about a 34% chance on Kalshi that both of these things gonna say. So let's say like 1/3 of a chance. So 1/3 of a chance that they're actually going to say, okay, fine, you can do your tariff thing, and 2/3 of a chance that you can't. So if you're in that market, well, all of a sudden now you know that there's this big market moving binary event that's occurring, and you know roughly where the average person or the market as a whole thinks that it's going to happen, right? So we're not, they think that they will not be able to do the tariffs, okay? So how do we think of this from a trader standpoint, and what can we potentially start to do with this? Well, if the whole market is kind of thinking no, that he's not going to be allowed to do the tariffs, or right, the Supreme Court is going to rule against it, that is likely what's going to be priced into, say, retailers, for example. I think this is the lowest hanging fruit. So if retailers are betting in that these tariffs are going to get lifted in some way, then the asymmetric part of the bet becomes very interesting, because you can go potentially to retailers and say, okay, if the surprise thing happens, which is they let him uphold the tariffs, then that should, in theory, put pressure and push retail stocks down. And then if they do the thing that nobody is shocked about, which would be them saying no to tariffs, then that shouldn't move stocks very much. So that's how you get this asymmetric kind of option where maybe, and again, I'm just talking out loud, it makes sense to potentially start looking at some of these retailers and saying, okay, if the expected thing happens, if I take a short in XRT, for example, let's just use XRT as a very basic example here. If I take a short in XRT, which is our retail ETF, betting that there is a world in which it's not expected, right? Sitting up here near highs, there's a world that the Supreme Court comes out and says, okay, tariff's good. If that's going to do what we think it's going to do, and it's going to push pressure on retailers, and retailers are going to push down, well, that's great. But if they come out and they say, no, tariffs are not okay, and we're going to undo them, well, that's what everyone's expecting anyway. So yes, maybe a little bit of a pop, probably really no price action one way or another. So this might not be the perfect example. I hope I'm getting across just with stream of consciousness what I want to say. But I think that we now have a very interesting tool that we have to start thinking about differently. And it's not saying I'm not going to start betting on Kalshi or anything like that, but we have now a tool to gauge overall market sentiment or overall market, what they're thinking is going to happen in the future. And that allows us to potentially put on bets like this, where there could be a surprise event to the downside in the retail space on this particular move. Automotives might be another way to look at it. A surprise move in automotives to the downside if tariffs are upheld. So we can start to bet ourselves or position ourselves in certain ways for these binary outcomes, but only when we see, the whole market thinks one thing and we're positioning ourselves for the potential that the other thing could happen. So let's take this same example, and let's say it was a 50-50 bet whether or not they would uphold tariffs or not. Well, then there's really no asymmetric bet there. Half the people think it is, half the people think it isn't. So whatever the Supreme Court comes out with, there's half of the world is going to be surprised. So the more that this would get closer to zero, the more I think this chance would have, where you have this one moment in time, they're going to do a court ruling that's going to make a move. So we have this potential to take a trade around something that there is an expected outcome. And again, if the expected outcome happens, there's probably going to be very little movement. But if the unexpected thing happens, there could be a whole lot of movement. So, take this, understand options markets. I know that's going to be the first counters. Oh, you can do this now in the options market. Option markets are very efficient, so they're probably already looking at this, and volatility has already been likely priced in that it's going to happen. So I'm not thinking that. I'm thinking purely directionally, is that we have the two outcomes, the expected and the unexpected. And if the expected moves us just a little bit and the unexpected moves us a lot, that's stuff that we can start to build trading strategies around.